Welcome to Inside My Money, everyone. My name is Kim, and I'm excited to have you here. On this channel, we're all about helping you take control of your finances, whether it's tracking your spending with HomeBank or guiding first home buyers through the ins and outs of savings, mortgages, and buying your dream home, then we're here to help. We've also got a website, and that's www.insidemymoney.co.nz, and that's got a lot more material on first home buying. But today's video is perfect for those of you trying to decide between a fixed rate mortgage, a floating one, or maybe even a combination of both. We're going to break it down and help you understand the differences between them, and then why some people might choose one, the other, or both. Now, don't forget to like, subscribe, and go over and join into the website as well, so you never miss a tip on mastering your finances and the home buying journey. Hi everyone, and welcome. If you're a first home buyer or looking to refinance, one of the big questions you'll face is, should I go with a fixed or floating interest rate? To explain things clearly, Laura is going to be the client asking the questions, and I'll be guiding her through the details. Just a quick note, this video is for general information only and is not personal financial advice. If you're a first home buyer or making decisions around what to do with your mortgage, please speak with a qualified financial advisor. Right, so let's get started. Hi Laura, I understand you have a question about mortgages.
Hi Kim, nice to see you. Yes, I do. I am getting a mortgage for our new home and I am not sure whether to choose a fixed or floating rate. Can you help me understand my options?
That's a common question and one that everyone faces. So we're going to start by looking at the differences between the mortgages. So let's move on and have a look at fixed rate mortgages first. So a fixed rate mortgage is also called a table loan, and this is where you pay both the principal, the amount you borrowed, and the interest back to the lender. Now, the interest rate is set for a certain period of time, so some people might choose it set for 6 months or a year or longer. And they'll do that depending on where they think interest rates might be going in the markets. Now your payments are then set each week, fortnight or month, depending on how often you want to pay back the mortgage. When the period is up, like the 6 months, then you'll have to choose another interest rate and another period. Does that make sense?
Yes, I understand that. What about for floating rate mortgages?
So a floating rate mortgage is also called a table loan. So again, you're paying back the amount that you borrowed plus the interest. But in this situation, the interest rate can go up and down, and that could be quite often depending on what's happening in the markets. So every time you hear about the OCR changing and banks changing interest rates, then your interest rate would change too. So as the lender changes the rate, your interest rate and your payments change too. So if interest rates go up, your payments can go up. If interest rates go down, then your payments could come down, or you could keep them the same. So does that also make sense?
Yes, that is all fine. So how do I choose which one to use?
Well, there's actually no perfect answer, but there are a few things that you'd need to consider when you're making your decision. So let's assume that you put all of your mortgage onto a fixed rate for 1 year. What's the advantage of doing that? Well, your payment amount isn't going to change, so that gives you certainty and you can budget each month more easily. If interest rates go up, then you'll still stay on that lower rate until your period ends. So this could be for 6 months, a year, or more. There are disadvantages to weigh up as well. If interest rates go down, then you're stuck on that higher rate and the higher payment amount. Some people like to pay lump sums off their mortgage when they get bonuses or extra money or extra savings, and that helps to clear your mortgage quicker. But on a fixed rate mortgage, you can't do that until the period rolls over. Sometimes you can pay a little bit extra off without penalties, but if you want to pay a lump sum amount off before the fixed period rolls over, you could be charged fees. So you just need to weigh up having certainty with the prospect of interest rates going down, or you wanting to pay more off your mortgage quicker.
So what happens if I put it all onto a floating rate instead?
So if you put it all onto a floating rate, then your payments could change more frequently if the lender is changing the interest rate quite often. So this means that you're going to have less certainty on how much you need to set aside each week or fortnight or month, so that can be harder to budget. If interest rates then go up, your payments will have to go up in order to keep the same term over the whole mortgage. So if you've got a mortgage over 25 years, then you're going to have to pay more to keep that same 25-year term. Now that can put more pressure on your finances, especially if rates are going up quite often and by quite a lot. And we have definitely seen this in the past. The advantage is, if interest rates come down, you could keep your payments the same and pay more off and pay it off faster. Alternatively, you could drop your payments down if money is starting to get a bit tight. If you get a bonus tax refund, or you do really well with your savings and you have a lump sum sort of sitting off to one side, then you can put that on the mortgage straight away and you won't pay any fees or penalties. So you just need to check with the lender to make sure that you are going to be okay. But that can really help you over the life of the mortgage. So the floating rate option is more flexible, but you do risk having to pay more when interest rates go up. So how does that sound?
That sounds good, but how do people decide what to do?
Well, that can be quite tricky because it depends on what your goals are for your mortgage, but it also depends on your financial situation and what you think interest rates are doing. A lot of people like to have a foot in both camps because we really don't know where interest rates are going to go over the longer term. So they put some on a fixed rate, which gives them certainty, but then they may also split that amount of money between 2 or 3 different fixed rates. So they might have some on a 6-month rate and some on a 1-year rate, and some then even split it even further than that. But then they like to have some on a floating rate because if interest rates do go down, then they'll get the benefit of that, or they want to be able to pay lump sums off their mortgage to pay it off quicker. Of course, it would be much easier if we knew where interest rates are going, but we can never know that. So they choose options that allow them to pay their mortgage off comfortably, but also as quickly as they can. So, how does that all sound?
That is really good, thank you. I have a bit to think about, so I will go away and think about what is important for us. Thank you, Kim.
Thanks, Laura. That was great. And thanks everybody for listening. If you want to see more of these types of videos, then remember to go on and subscribe to our YouTube channel. You can also go to our website, www.insidemymoney.co.nz, and check out all of the extra material that's on there too. Become a member. It's only $20 a month. And you can get access to all of our material that's on in the members section. And we'll talk again soon.